What's up, everyone? This is Eric with Theme Options Trading, and today we're going to talk about risk management tracking, identifying edge, and optimizing edge. Let's first talk about two important terms that really change the path of my trading career. First, max adverse excursion, or MAE. MAE is the lowest trade price against your long position, or in other words, your potential max loss. This is a little more easily explained through a picture. Let's say you have an entry at $10 and your stop loss is set at $9.20, but your max loss, had you not had a stop, would have been at $9. So this means that your MAE was 125% or a dollar. This is really important. Over a lot of trades for a specific position, this will tell you if your stop is set appropriately. Is it set too wide or is it set too tight? You can use this number to determine that. This number tells you how much wiggle room you have for your stop loss. But keep in mind, this is only one piece of the equation. If you widen your risk, you're going to lower your risk to reward ratio. So you always need to understand that yes, you can optimize your stop, but you need to take it with a grain of salt and look at it as a piece of the larger puzzle. Next, max favorable excursion, or MFE. This is the highest trade price in favor of your long position, or in other words, your potential max gain. Let's say you entered at 10 bucks, but you exited at $15. And the max gain, had you top ticked your exit, would have been $20. Here, your MFE would have been 200% or $10 because a top tick exit would have been a $10 profit on this position. But this needs to be taken only as a piece of the larger picture. Why? Yes, in an ideal world, we want this number to be 100%. We want to top tick every exit. But what happens if you adjust this? Your win rate's going to change. So yes, this tells you if your profit targets are too tight or too wide, but keep in mind, same with MAE, if you adjust this number, this will affect your overall edge, which we will get into shortly. Before diving in to tracking edge and optimizing edge, let's talk a little bit about risk management. This is harped like crazy within the trading realm, and it's really important. Risk management essentially puts the fate of your trading career in your hands. If you have too much risk, you're going to blow up your account and potentially not be able to trade again from a financial perspective. Or if you're really good at risk management, this gives you more time in the trading game and more time to make it. And time in this field is really important. So this is a manual risk management tracker that I built. There are some risk management tracking softwares out there, but I've always found little holes in the software and you have to pay for them. This allows me to, one, track the metrics that I want to track, and two, manual entry goes a long way. It's similar to writing things out versus just saying things. If you write things out, you retain them a lot better than just saying something. Same thing with this risk management tracking. If I manually enter my profit and loss for each and every day, that's going to sit with me a little different. You better believe when I first started trading and this whole calendar was red, it sucked. Seeing sometimes 10 red days in a row, it made me want to get to work that much more to finally get a green streak of 10 days. How does this work? Account size, your risk as a dollar amount, your risk as a percentage that'll automatically calculate for you, daily max loss. This and position max loss are something that you need data over yourself to help you determine. I know for me, if I lose 3R in a day, mentally, I'm not in the right space. Anytime I'm down 3R, done for the day. It sucks, but I know that if I lose more than 3R, that number will get a lot worse. Sometimes, yeah, I'll get back to even and sometimes even green. But from what has happened for me in the past, I know that this number can and has gotten a lot worse if I'm down 3R during a day. Position max loss, 2R. For me, I know that for my A plus setups, this is the max risk I can tolerate and lose and still be okay. If this number is larger and I lose, I start getting in the mindset of wanting to revenge trade and don't want to go down that rabbit hole. The way this spreadsheet works is you want to enter in your profit and loss for each day in these pink cells here, $1,000. What does this do? This will calculate how much R you were up or down on the day, green if you're up, red if you're down, and it gives you a weekly total for both your profit, weekly total for your R, monthly total for your profit, monthly total for your R. Manual entry goes a long way. If I'm over here at the end of the day, all of these red days, it sucks. It sucks. If I looked at this and saw that I had a week like this, you better believe on this Friday, after I entered my 4th red day in a row with a loss of near 10R, I'm definitely going to get to work over the weekend to start fresh the next week. And I'm only going to be that much more motivated solely based off of manually entering this data rather than have a software do this for me automatically. This also shows you your largest win of the month, your largest loss of the month, your average winner, your average loser, and your account change during the month. This spreadsheet you can purchase on my website as well as a trade log, but for watching this video, I'm going to offer a discounted rate, which I will post in a link below in the description. This spreadsheet I've slowly built and updated throughout my trading career, and this has really helped me. I'm not going to get into the full spreadsheet, and I want to make one thing very clear. This is not to become a systematic data trader. It may seem that way, but it's not. My intent here is to see how do I respond to specific stock behavior. I want data over myself to make sure I'm executing appropriately and to make sure my edge is optimized. So real quick, I have a legend over here on the left. The white cells, things you need to enter in manually. The titles that have a blue cell color, these columns will update automatically. This pinkish color is for your Greeks, and the green cells are updated automatically based off of this adjusted stop loss and your profit target. So let's dig into edge optimization. What do I track here? I track risk to reward ratio, win rate, edge, really important. From a high level, do you have edge, yes or no? And the higher the number, the better. Your MAE from a dollar and percentage perspective, and MFE from a dollar and percentage perspective. Okay, so now let's look over here at the adjusted column. I have two numbers plugged in here to show what would happen if I increase my stop loss by 5% and how would adjusting my profit targets by 30%, a 30% increase, how does this affect my data? Let's look at it. Risk to reward ratio, 15. Is that better than 14? Yeah. Win rate, the same. Higher risk to reward ratio, same win rate. This is the better trade. But let's say we didn't have the same win rate. How would we know? Well, let's look at this adjusted edge. Is 648 higher than 621? Yes. So this is the better strategy here. How did this affect our MAE? So this tells us the amount of wiggle room we have from a stop loss perspective. 130%, okay, not bad. But what about our MFE? So we want this number to be as close to 100% as possible. But remember, this does affect your win rate. 163% versus 264%. So yes, we are extracting more from adjusting our profit target by 30% while maintaining the same win rate. But the most important number is your adjusted edge percentage to see if this strategy is truly better. You can really dig deep here by trying to optimize your stop loss and optimize your profit target to try to find the best stop loss and target adjustments for your setup, which I recommend doing. But instead of going down the rabbit hole of trying to calculate more than just your edge, which you can, for example, expected growth, average gain per trade, amongst a ton of other things, I recommend plugging this data into this P&L sim to see potential outcomes for your trade and a visual example on this simulator. So why do I recommend not going down that rabbit hole and just looking at the sim? Well, this is my opinion, but I don't believe that the stock market can be boiled down to numbers. And also the age-old saying of just because something has happened in the past doesn't mean it's going to happen in the future. So rather than going down that rabbit hole, just input these numbers in this simulator. Before we get to the simulator, I'm going to talk briefly about position sizing. And this is going to show your optimal position size based off your win rate and risk to reward ratio. So looking at just what I have right here posted, 4-to-1 risk reward, win rate 30%. This tells us for the optimal position size, we need to risk 10% of our account on each trade. If we had an 85% win rate, this would say we need to risk 50% of our account on each trade. Hypothetically speaking, let's say we had this 85% win rate with a risk reward of 4. But can you stomach a 50% loss on 15% of your trades? That is really hard. That is really hard. And that's for you to decide. Also, you need to take into consideration liquidity. If you have a large account, how's the market going to respond to this? Is there going to be someone on the other side to fill your orders? So I use this as just an idea of how much I should be risking on each trade. And this does update as you input these numbers here. So let's use what we found on the last page, 15 R to R, 46% win rate. It wants us to risk 50% of our account, but we've already gone over that. Lastly, P&L sim. So let's look at a visual representation of the strategy that we just optimized. Starting capital, 30K. Risk to reward, 15. If we had fixed risk, $300, this is off of your risk tab. Win rate, 47%. Or 1% risk, also off your risk tab. And this data will update each time you change something on the spreadsheet. What does this tell us here? If we have a fixed risk on each trade, after 100 trades, our ending capital should be about 200K. That's really good. But what's better? Well, if we risked 1% of our account each trade rather than a fixed $300, our ending capital would be close to $11 million. That is a huge difference. Like we briefly mentioned on the last slide, though, look at our max drawdown. If we risked 1% of our account, our max drawdown would have been $459,000. That is over 10 times your starting capital. That is crazy. Assuming liquidity was not an issue, that would be really hard to swallow if your account was 30K and then you lost more than 10 times that on one trade. Really hard to swallow. If we use fixed risk, one scenario for our max drawdown would be $1,800. So what do I do? Do I do fixed risk or percent risk? I do fixed risk and I increase it accordingly. So let's say my R was $500. Okay, I feel really good at $500. I can swallow $500 losses, no problem with my win rate, risk reward ratio, all the math. Let me try to increase that to $1,000. Okay, whoa, after I lost one trade, that was really hard to swallow. All right, let me try to decrease this a little more. 750. Okay, I feel good at this. So percent risk does look really appealing, but you need to consider you're a person, you have emotions. So while for me, I'm not getting the most out of the market by using percent risk, I'm okay with that. I'm okay with that. I have found a risk unit that works for me and an increasing methodology that has worked for me. This will not be the same for everyone. You know yourself more than anyone else. And that's it. Please like this video, leave a comment below, and subscribe to my channel or visit my website. As I said earlier, I'll have a link below to download the spreadsheet in the description. Until next time.